Hey guys, how's it going? Joseph Henson here with Henson CPA Group. Last week we went to the puzzle of what is your company really, and this week we're gonna go beyond the numbers over what your veterinary P&L isn't showing you. Uncover the hidden insights behind your clinic's financials. Again, I'm Joseph Henson with Henson CPA Group, and I'm glad you guys are joining me this week. So, why is your profit and loss statement, your P&L, your income statement, why that alone isn't enough? I've said it before. This is going to show you some fantastic information. It will show your revenue and your expenses, what you're bringing in, what you're paying, but it doesn't tell the whole story. It can mask inefficiencies and missed opportunities within your clinic. You won't even know these are happening because it's not looking at the whole picture. It's not looking at your balance sheet. It's not looking at your aging statements. It's not looking at your cash flow. And it's the true financial health isn't looking past the surface. You really need to dive into your numbers to understand how you're doing. What are some of the limitations of a profit and loss statement? It does not show cash flow or liquidity. What is bringing in, what is going out, how liquid is your company? That means how much cash is on hand or how fast can you get it? It doesn't explain staffing efficiencies or inefficiencies. We talked about this before. You have staff that are just sitting around twiddling their thumbs. That can lead to some really big staffing inefficiencies. It doesn't reveal client retention or missed charges. If you're in a clinic and you're having folks who aren't charging the clients because, well, it's expensive, they're having a hard time, I've known them for years, that's a problem. And it doesn't tell whether the debt you're carrying is sustainable. You might be able to do it for now, but what does that really look like? Is that hindering your growth? Is that tampering the cash flow? That's the thing that this isn't going to just be seen by the income statement. This does have some cash flow blind spots. You may look profitable while cash is tight. You may have $50,000 worth of net income through June, so $100,000 when year end comes, but you don't truly have a lot of cash on hand. $20,000 in, $18,500 out. That's only an increase of $1,500. Example is going to be the profit on paper, but low cash due to inventory or debt payments. If you have a lot of debt you're paying, some of that does not go on the income statement. If you have a lot of inventory on hand, that's not always on the income statement. Staffing blind spots. The P&L shows wages, but not whether staff is efficiently scheduled. You need to be looking at how well you're scheduling your staff. How much downtime do they have? Labor percent of revenue is often overlooked. What is the labor percentage of revenue? I would take you out sometimes, but if you are the only doctor, maybe it makes sense. And then overtime is hidden in your payroll totals. You don't know how much you're paying in overtime if you only look at one area, unless you've broken this out on your P&L. Most folks don't, because it doesn't necessarily matter for your bottom line until you realize, oh, this person makes more than I do per hour when they're hitting overtime. That's an issue. Pricing and revenue blind spots. High revenue doesn't always mean high profit. What do I mean by that? Just because you brought in $1 million doesn't mean your profit is going to be great. You might not even hit a 10% profitability margin. You might not even make $100,000 in net profit. Discounts and unbilled services can distort true margins. You might be giving up 5 to 10% just with discounts. And then unbilled services, that can completely blindside you if you aren't paying attention to it. If you're just allowing people to do their own billing and you're not verifying what's happening, that can hurt you. And then missed charges are invisible in the P&L unless tracked separately. You need to be looking at your software to see what's scheduled, what are their notes, how does this actually look? Some overhead blind spots. So overhead as a percentage of revenue can be hidden in line items. You look at just salaries, you look at marketing, admin, utilities, supplies, rent. These are all overhead, but you don't necessarily know what percentage of revenue that really represents. You need to take some benchmarking figures with overhead and look at other clinics that kind of let you know where you're leaking money, where you're hemorrhaging, what is going on here. Owner's draw and debt. If you take money out other than as a paycheck, This will not show up on your profit and loss statement. These are hidden on the balance sheet in the owner's equity section. Loan payments and debt service don't appear fully on the P&L. When you make a $100 payment to your loan, $90 of that might go to the balance sheet and only $10 shows up on your income statement. I've explained that before, and it's one of those things where we want to make sure that you're also paying attention to the cash flow statement. And I know I harp on that, but if you're only looking at one thing, I don't know where my money's at. It's because of that. If you don't know what's hitting the income statement, you could have a $5,000 payment on the balance sheet and none of the interest is getting hit until year end. That cannot happen. It's extremely impactful and hurts your business. These are both areas that are impacts on cash, and it will help with your sustainability, but you have to start paying attention to it. And if you ignore these items, you will have a false sense of security. You want to make sure that you're paying attention to all of these, because of the fact if you don't, the next thing you know, you're racking up credit card debt, you're taking predatory loans out so that you can pay your employees. It will destroy you. Reading between the lines. You should have different layers in KPIs. Labor percentage, revenue per full-time employee, FTE, gross margins. These are some really good ones that anyone can calculate. Labor percentage, you take your total labor cost divided by your gross revenue. Revenue per full-time employee, you take your revenue and divide it by how many full-time employees you have. If you have 8 full-time and 3 part-time, you really have 9 full-time equivalent. You can round that up to 10 for that one other half-time person, but I wouldn't. And that's going to give you the revenue per full-time employee. And then gross margin, we've kind of talked about before. Review your balance sheet and cash flow alongside your profit and loss statement. If you have QuickBooks, you can go to management reports under your reports section, and it will give you a nice little report. It's there. It can be utilized. You don't always know what it means. And when that happens, ask yourself what's missing here and not what's on here. That's one of the things you can do. And if you have questions over that, as always, feel free to reach out. I'm Joseph Henson with Henson CPA Group. I'm glad you guys joined us. We help veterinary clinics uncover the full financial picture and make smarter decisions. Until